All right, new this morning, new data showing that credit scores are falling at the fastest pace in the U.S. since the Great Recession, as Americans struggle to keep up with the rising cost of living.
Chapter 1. The number that runs your life. There is a 3-digit number attached to your name right now. You did not vote on it. You did not agree to be scored. Nobody asked your permission. And yet that number determines whether you can rent an apartment, buy a car, get a mortgage, start a business, or in some states, even get a job.
Passport into everything that you need to do as an adult.
Your credit score is one of the most powerful numbers in your financial life, and most people have almost no idea how it actually works, who profits from it, or why the system was built the way it was. Here is what is stranger still. The credit score as we know it today did not come from a government agency or a public institution. It came from a private company built by an engineer who was trying to help banks lend money more efficiently. It became the most consequential financial measurement in the modern economy almost by accident. And the industry that grew up around it, the credit bureaus, the scoring companies, the monitoring services, the repair firms, now generates billions of dollars in annual revenue, almost entirely from ranking you. This is a story of how that happened. And by the end, you will understand the machine well enough to stop being its passenger. Chapter 2. Before the credit score existed. Before the credit score existed, lending was intensely personal and deeply arbitrary. If you wanted a loan in the 1950s, you walked into your local bank and sat across from a loan officer. That person made a judgment call. They evaluated your employment, your reputation in the community, whether they knew your family, how you dressed, how you spoke. There was no formula. There was no consistency. And there was enormous discrimination. Women were routinely denied credit, regardless of their income. Black Americans were systematically excluded from lending in ways that were legal and explicit. The process was slow, inconsistent, and dependent entirely on the subjective opinion of whoever happened to be sitting behind the desk.
And it affects so many things, not just access to credit. So your ability to get a credit card, a mortgage, a reasonable car loan, landlords.
Banks knew this was a problem, but they did not know how to fix it. The volume of lending was growing. The country was expanding. Banks needed a way to evaluate risk at scale. That is where Bill Fair and Earl Isaac came in. In 1956, Fair, an engineer, and Isaac, a mathematician, founded a company called Fair, Isaac & Company in San Jose, California. Their idea was straightforward. Use data and statistical modeling to predict whether a borrower would repay a loan. Remove the human bias. Replace it with math. For the first 2 decades, adoption was slow. Banks were skeptical. The idea of replacing human judgment with a score felt wrong to people who had been doing it the old way their entire careers. But the math worked. And eventually, the industry followed. Chapter 3. How the Fico score took over. The turning point came in 1989. That year, Fair Isaac released the FICO score as a standardized product that any lender could purchase. For the first time, a bank in Ohio and a bank in California could evaluate the same borrower using the same formula and get the same number. The credit score became a universal language for risk. Fannie Mae and Freddie Mac, the government-backed entities that buy mortgage loans from lenders, began requiring FICO scores as part of the mortgage underwriting process in the early 1990s. That decision alone locked the FICO credit score into the center of the American housing market. Every mortgage lender who wanted to sell loans to Fannie and Freddie, which was nearly all of them, now had to use FICO. From there, adoption cascaded. Auto lenders, credit card companies, personal loan providers, landlords. By the late 1990s, the credit score was everywhere. The numbers behind this are staggering. According to Fair Isaac Corporation, now publicly traded under the ticker FICO, more than 90% of top US lenders use FICO scores in their credit decisions. Over 10 billion FICO scores are sold to lenders annually. The company reported revenues of $1.72 billion in fiscal year 2023. That is a private company generating nearly $2 billion per year from a scoring system that most Americans are required to participate in, whether they know it or not. But FICO does not work alone, and this is where the system gets more complicated. Chapter 4. The 3 bureaus and the data empire. The credit score is not generated from thin air. It is calculated from data. And that data is collected, stored, and sold by 3 private companies, Equifax, Experian, and TransUnion. These are not government agencies. They are corporations. And their business model is to collect as much financial data on as many Americans as possible, and then sell access to that data. The scale of what these companies hold is almost difficult to comprehend. Equifax alone maintains financial data on more than 800 million consumers globally, according to its own corporate filings. Experian reports data on over 1 billion people across 44 countries. TransUnion covers more than 500 million consumers in over 30 countries. They collect this data from lenders who report your payment history, balances, and account status every month, from public records, including bankruptcies and court judgments, from utility companies and telecom providers, from landlords who choose to report rent payments. None of this was built with consumer benefit as the primary purpose. It was built to serve lenders. The credit bureaus are fundamentally in the business of selling information about you to companies who want to decide whether to give you money. and on what terms. The consumer credit monitoring products these companies sell, the credit score alerts, the identity protection subscriptions, the credit freeze services, are a secondary revenue stream built on top of the original lender-facing business. They are, in a very real sense, charging you for access to your own data. According to IBISWorld, the credit reporting industry in the United States generates over $16 billion in annual revenue. Most of that money flows from lenders paying for access to your file. Some of it now flows from consumers paying to see or protect that file. But here is what very few people ever stop to ask. If the bureaus make money by selling information to lenders, whose interest do you think the system is actually designed to serve? Chapter 5. What a credit score actually measures. Most people think a credit score measures whether you are good with money. It does not. A credit score measures one very specific thing: the statistical probability that you will repay a particular type of debt over the next 24 months. That is it. That is the entire purpose of the number. It says nothing about your income, nothing about your net worth, nothing about how much you have saved, how wisely you invest, or how financially responsible you are in any broader sense. A person with $2 million in savings and no debt can have a lower credit score than a person with no savings and 10 open credit card accounts, because the person with savings has not demonstrated enough recent borrowing behavior for the model to evaluate. The FICO score is built on 5 components. Payment history accounts for 35% of the score. Amounts owed, meaning how much of your available credit you are using, accounts for 30%. Length of credit history is 15%. Credit mix, meaning having different types of accounts, is 10%. And new credit inquiries make up the remaining 10%. Notice what is not in that formula: your income, your savings, your job stability, your actual ability to repay. The credit score was built to predict behavior within the credit system, not financial health, not wealth, not responsibility. Behavior within the credit system. Those are not the same thing. This matters because millions of Americans have made genuinely sound financial decisions, like avoiding debt, paying cash, not taking on credit cards, and those decisions have left them with thin or non-existent credit files that produce low credit scores despite real financial stability. The system does not reward being good with money. It rewards being a predictable borrower. The distinction has enormous consequences. Chapter 6. The Credit Utilization Trap. The single most misunderstood component of the credit score is credit utilization, and it is responsible for more unnecessary score damage than almost any other factor. Credit utilization is the ratio of your current revolving balances to your total revolving credit limits. If you have a credit card with a $10,000 limit and you carry a $3,000 balance, your utilization on that card is 30%. Most financial advisors recommend keeping utilization below 30% to protect your credit score. The highest scores generally keep it below 10%. Here is the trap. Utilization is calculated based on the balance your lender reports to the bureaus. And most lenders report the balance on your statement closing date, not the date your payment is due. That means even if you pay your credit card in full every single month, if your balance on the statement closing date is high, your credit score takes a hit as if you are carrying that debt. People who responsibly use credit cards for everyday spending and pay them in full monthly are often being penalized for behavior that is objectively financially sound. They are not in debt, they are being measured as if they are. The fix is to pay down your balance before the statement closes, not after. But this is information you have to actively seek out. The credit bureaus are not going to send you a tutorial. There is a deeper issue here too. Because utilization is measured monthly and can swing dramatically based on a single large purchase, your credit score is far more volatile than most people realize. A credit score is not a fixed assessment of your credit worthiness. It is a snapshot, recalculated constantly, based on data that can change within a billing cycle. Lenders know this. Most consumers do not. Chapter 7. The error problem nobody talks about. In 2013, the Federal Trade Commission published a landmark study on credit report accuracy. The findings were striking. 1 in 5 Americans had a verified error in at least one of their 3 credit bureau files. 1 in 20 had an error significant enough to materially affect their credit score. And 1 in 250 had an error severe enough to push them into a higher risk category, meaning higher interest rates, denied loans, or rejected applications. The CFPB has consistently found, through subsequent research, that credit report errors remain widespread and difficult to correct. The dispute process is where things get genuinely troubling. When you dispute an error with a credit bureau, the bureau is required under the Fair Credit Reporting Act to investigate within 30 days. But the way that investigation typically works is the bureau sends an electronic inquiry to the lender who reported the information, asking them to verify it. If the lender says the information is accurate, the bureau marks the dispute as resolved, even if the information is demonstrably wrong. The bureaus process hundreds of millions of disputes annually. Almost none of them involve a human being at the bureau actually reviewing the underlying documentation. The system is largely automated, and it is biased toward the lender, not the consumer, because lenders are the bureau's paying customers. People who have fought legitimate errors out of their credit reports often describe a process that took months, required multiple rounds of dispute letters, regulatory complaints, and in some cases, litigation. All of that effort to correct data that was never accurate to begin with, that you had no role in generating, and that you were never told existed until it was already affecting your financial life. Chapter 8. the industry built on your fear. Once the credit score became the gatekeeper to financial life, a secondary industry emerged to profit from the anxiety it created. Credit monitoring services, credit repair companies, score simulators, identity protection subscriptions, secured credit card issuers, specifically targeting people with bad credit scores, credit building loan products. The industry built around credit score management generates billions of dollars per year, and the vast majority of it is selling you tools to navigate a system that was not designed with you in mind. Credit monitoring services, sold by the bureaus themselves and by third parties, typically charge $10 to $40 per month to alert you when your credit file changes. The irony is that you are entitled to free access to your credit reports from all three bureaus every week through annualcreditreport.com under federal law. Many of the alerts these services provide are available to you for free. You are paying for convenience and for the anxiety management of feeling watched over. Credit repair companies are a particularly complex part of this ecosystem. The industry is regulated by the Credit Repair Organizations Act, which prohibits companies from charging upfront fees before services are rendered and requires them to disclose that you can dispute errors yourself for free. Many companies ignore these rules. The FTC regularly takes action against credit repair scams. But here is the uncomfortable truth underneath the fraud. The legitimate credit repair industry, the compliant, law-following companies, can largely only do things you can do yourself. They can send dispute letters, they can identify errors, they can coach you on which accounts to pay down first. None of that requires a paid intermediary. It requires time and the willingness to learn how the system works. The credit score industry profits most from the people who understand it least. That is not a coincidence. Chapter 9. How credit scores affect people differently. The credit score is often presented as a neutral, objective measurement. The math does not see race. It does not see gender. It just sees behavior. But the data says something different. A 2022 report by the National Community Reinvestment Coalition found that Black and Hispanic Americans have significantly lower average credit scores than white Americans. The Urban Institute has documented similar gaps repeatedly. The median credit score for Black Americans is approximately 40 to 50 points lower than for white Americans, according to data analyzed by the Consumer Financial Protection Bureau. The credit score itself does not discriminate, but it inherits the discrimination that came before it. Redlining, the systematic exclusion of Black neighborhoods from mortgage lending that was practiced openly until the Fair Housing Act of 1968 and continued informally for decades after, meant that entire communities were denied access to the credit-building tools that generate credit history. No mortgage, no credit card approvals at favorable terms, no auto loans at competitive rates, no credit history, no credit score. A credit score built on credit history cannot be neutral when access to credit was historically distributed along racial lines. The scoring system encodes historical inequity and then treats the output as an objective fact about the individual. This is not a theoretical concern. A lower credit score means a higher interest rate. A higher interest rate over 30 years means tens of thousands of additional dollars paid to lenders. That gap compounds across generations. It is one of the mechanisms through which the racial wealth gap perpetuates itself. The credit score does not create the problem, but it reliably amplifies it. Chapter 10. The Vantage Score Challenge and the Scoring Wars. For decades, Fico held a near monopoly on credit scoring. Then, the three major bureaus decided they wanted a piece of that business. In 2006, Equifax, Experian, and TransUnion jointly created Vantage Score, a competing credit scoring model that they own and operate together. Vantage Score uses a scale of 300 to 850, the same as FICO, which was a deliberate choice to make the two scores feel interchangeable to consumers. They are not interchangeable. Vantage Score and FICO use different algorithms, weight factors differently, and can produce meaningfully different scores for the same consumer from the same underlying data. A person might have a 720 FICO score and a 695 Vantage score, or vice versa. Those differences can cross the thresholds lenders use to qualify borrowers or set interest rates. The proliferation of credit score versions. FICO has released more than a dozen versions of its model, with FICO 8 being the most widely used by lenders, even though FICO 10 and FICO 10T are newer and more predictive, creates genuine confusion for consumers trying to understand where they stand. The score you see on your bank's app is often a Vantage score, or an older FICO version that does not match the score the mortgage lender will actually pull. This is not disclosed clearly. Many consumers build their financial understanding around a number that is not the number that will determine your mortgage rate. The Federal Housing Finance Agency announced in 2022 that Fannie Mae and Freddie Mac would begin accepting FICO 10T and Vantage Score 4.0 for mortgage underwriting, the first major change to the mortgage scoring framework in decades. That transition is still unfolding. Until it is complete, the gap between what consumers see and what lenders use remains a real source of confusion. Chapter 11. The thin file problem, and the people the system ignores. The credit score system has a structural blind spot, and approximately 45 million Americans fall into it. The Consumer Financial Protection Bureau estimates that 26 million Americans are credit invisible, meaning they have no credit file at the major bureaus at all. Another 19 million are unscorable, meaning their files exist but do not contain enough recent information to generate a reliable credit score. These are not necessarily people who are bad with money. They are people who have simply not engaged with the credit system in ways that bureaus can measure. Immigrants who are new to the country, young adults who have not yet opened credit accounts, people who have historically used cash or debit, people who paid off all their debts years ago and have not borrowed since, older Americans who paid off their mortgage and closed their cards. For all of these people, the credit score system returns a verdict not of good or bad, but of non-existent. And non-existent is often treated as worse than bad. A landlord who runs a credit check and gets no score may reject an applicant more quickly than one who sees a 580, because at least a 580 means there is data to evaluate. Invisibility is its own form of disadvantage. The credit score system rewards participation, not responsibility. If you participate in the system, pay on time, keep balances low, you are rewarded with access. If you do not participate for any reason, you are penalized, regardless of your actual financial behavior. New models like Fico XD and Experian Boost attempt to address this by incorporating non-traditional data like rent payments, utility payments, and telecom payments, but adoption among lenders remains limited. The thin file problem is real, and the mainstream credit score system has not solved it. Chapter 12. What actually moves your credit score? Enough of the system mechanics. Here is what actually works. Payment history is 35% of your FICO score. Nothing matters more. A single missed payment can drop a credit score by 60 to 110 points, depending on your starting point, according to FICO's own simulation data. And that missed payment stays on your credit report for 7 years. Paying on time every time is not optional if you want a strong credit score. It is the foundation everything else sits on. The second lever is utilization, and this one you can move fast. Because utilization is recalculated every month based on reported balances, paying down revolving balances produces a relatively quick credit score response. Pay down high balances and you can see meaningful improvement within 1 to 2 billing cycles. The third lever most people overlook is credit limit increases. If your utilization is high, but you cannot pay down the balance immediately, requesting a credit limit increase from your existing lender reduces your utilization ratio without requiring you to spend less. A $3,000 balance on a $10,000 limit is 30% utilization. The same $3,000 balance on a $15,000 limit is 20% utilization. Your balance did not change, your credit score improved. The fourth lever is time. Length of credit history is 15% of the score. The average age of your accounts matters. Closing old accounts can hurt you because it reduces your average account age and can also reduce your total available credit, increasing utilization. Keeping old accounts open, even unused ones, is generally the right move for credit score purposes. The fifth lever is strategic new credit. Hard inquiries from new applications lower your credit score temporarily, typically 5 to 10 points each. But multiple inquiries for the same type of loan, like mortgage shopping, within a 14 to 45-day window are treated as a single inquiry by FICO. This is a feature most people do not use when they should. Chapter 13. The credit score as a business model. Step back from the individual strategies and look at what the credit score system actually is, from a structural standpoint. FICO charges lenders per score pulled. Every time a lender runs your credit, Fair Isaac Corporation earns money. Every mortgage application, every auto loan inquiry, every credit card approval process generates revenue for the company that created the scoring model. According to FICO's annual report, its scores segment generated $862 million in revenue in fiscal year 2023, a 14% increase year over year. The bureaus charge lenders for access to the underlying credit data. They also charge consumers for monitoring services and reports. And they sell credit data in aggregated and individual forms to a broad range of industries beyond lending, including insurance companies, employers, and marketers where permitted by law. The CFPB has been investigating and taking action against credit reporting companies with increasing frequency. In 2023, the agency fined Equifax $15 million for repeatedly failing to properly investigate consumer disputes and continuing to sell credit reports containing known errors to lenders. That fine represents less than 1% of Equifax's annual revenue. The regulatory framework around credit reporting was largely established by the Fair Credit Reporting Act of 1970, written before the internet, before algorithmic scoring at scale, and before the data industry that exists today. Critics, including former CFPB director Rohit Chopra, argued publicly that the credit reporting system is fundamentally broken in ways that 1970s legislation cannot adequately address. The system will not fix itself. The incentives run in the other direction. Chapter 14. The hidden system behind the score. Here is what this story is really about, underneath the numbers, and the regulations, and the bureau revenue figures. The credit score is a mechanism for sorting people, and like every sorting mechanism, it produces winners and losers. The people who understand how the machine works get to use it in their favor. The people who do not understand it get used by it. The lender who pulls your credit score before approving your mortgage has access to information about how the scoring model works that you may never have seen. The credit card company that sets your limit understands utilization mechanics that most cardholders never learn. The financial industry has spent decades building expertise around a system that most consumers interact with as a black box. The credit score was supposed to democratize lending, replace subjective human bias with consistent mathematical objectivity. In many ways, it succeeded. The discrimination that was explicit and legal before the 1960s is now largely illegal, and a credit score does not ask your race or gender. That is real progress. But the credit score also created a new form of stratification, one based on data, which sounds neutral, but which encodes history, encodes access, and rewards the sophisticated over the uninformed. The people with good credit scores often have them not because they are more financially responsible, but because they learned the rules earlier and had better access to the tools that generate credit history. The insight is this: the credit score does not measure your financial character. It measures your relationship with the financial system. Those are not the same thing. And once you understand the difference, you stop trying to improve your character and start understanding the machine. Closing reflection. You now understand something that most people who have a credit score have never been told. The credit score is not a measurement of your worth. It is a product. It was built by a private company, fed by data from other private companies, sold to lenders who pay for access, and surrounded by an entire industry that profits from your anxiety about the number. That does not mean you can ignore it. In the current system, your credit score has real consequences for your financial life, but you should engage with it from a position of understanding, not fear. Here is what to do right now. Go to annualcreditreport.com and pull your credit reports from all 3 bureaus for free. Read them. Look for errors. If you find something that is wrong, dispute it directly with the bureau in writing and keep records of everything. Check your utilization ratio. If it is above 30%, make a plan to bring it down, whether through paying down balances, requesting limit increases, or both. If you are mortgage shopping, car loan shopping, or evaluating any major loan, do all your applications within a 30-day window to minimize the inquiry impact on your credit score. And stop paying for credit monitoring services that are selling you information you can access for free. Use that money to pay down your balance instead. The credit score machine is going to keep running. It is going to keep ranking you. The only question is whether you understand the rules well enough to work them in your favor. Now you do.